Picture this. You've just received your paycheck, and after paying bills and covering expenses, there's a little extra sitting in your bank account. That money could just stay there, earning a modest 0.47% interest while inflation chips away at its value, or it could become something far more powerful. Welcome to the world of investing, where your money doesn't just sit idle, but actually works for you, growing and multiplying over time. If you've never invested before, the entire concept can sound like it's reserved for Wall Street professionals or people with six-figure salaries. But let me tell you something that might actually surprise you. You don't need thousands of dollars to start building wealth. Many brokerage platforms today allow you to open accounts with zero minimum balance, and some apps will even start investing your spare change once you've accumulated just $5. The barrier to entry has never been lower, the opportunity has never been more accessible. First of all, let's talk about why investing matters in the first place. Your traditional savings account may feel safe, but there's a hidden cost to keeping all your money in cash. When inflation reached as high as 3.4% in 2024, while the average savings account paid around 0.47% interest, your purchasing power was actually shrinking. That $100 bill from last year, it buys less today. Investing offers a way to not only protect your money from inflation's erosion, but to actually grow your wealth over time. It's how you build the resources to retire comfortably, buy a home, or achieve whatever financial freedom means to you. Before you rush to download a trading app and start buying random stocks, let's set some basic foundational rules that set apart the successful long-term investors from the ones that lose money chasing quick gains. First of all, you have got to understand your why. Are you saving for retirement that is decades away, or are you building a down payment fund for a house you want to buy in 3 years? Your time horizon completely changes your strategy, because someone who can invest for 40 years can weather market storms that would devastate someone who needs their money next month. This brings us to one of the most powerful concepts in all of investing: compound interest. It was allegedly called the most powerful force in the universe by Albert Einstein. And once you see the numbers, you'll understand why. Here's how it works. Let's say you invest $1,000 and earn a 6% return in your first year, giving you $60 in gains. In year 2, you don't just earn 6% on your original $1,000, you earn it on the entire $1,060. That means you gain $63.60. In and of themselves, the difference might seem small, just a few extra dollars, but time transforms this mathematical principle into something remarkable. After 20 years with no additional contributions, that initial $1,000 grows to over $3,200. After 30 years, it becomes nearly $6,000. The gains aren't linear, they're exponential, building upon themselves like a snowball rolling down a mountain, gathering mass with each rotation. Time represents the greatest potential of compound interest, and for this reason, financial advisors always tell people to start as early as possible. A person who invests $3,000 per year starting at age 25 will end up with substantially more money than someone who invests the same amount starting at age 35, even though the second person might contribute just as many years. Those extra 10 years in the market make an enormous difference because your money has more time to compound and multiply. But herein lies the problem for many novice investors. They try to time the market, waiting for the perfect moment to invest when prices are lowest. Research from Schwab shows that investors who missed just the top 10 trading days between 1993 and 2013 saw their annual returns fall from 9.2% to 5.4%. The math is pretty basic. Predicting market movements, even for professionals, is close to impossible. The more effective strategy is known as dollar cost averaging, whereby you invest a consistent amount at regular periods, say monthly, irrespective of whether the market has topped or is at its lowest ebb. This strategy eliminates the emotional tendency to time your entry point perfectly and ensures that you purchase at average prices over time. Another bedrock principle to help safeguard your portfolio against disastrous losses is diversification. Suppose you were to invest in the stock of a single company. If the company performed exceedingly well, you stood to reap spectacular gains. However, if it faltered or encountered unforeseen circumstances, your whole investment could be wiped out. Diversification entails spreading your investments over various asset classes, such as stocks, bonds, and real estate, and then within those asset classes, diversify in different sectors and geographic regions. Though this will by no means ensure total gain in any single market boom, it will protect you from complete elimination in any single market crash. Think of it as financial insurance, ensuring that when one area of your portfolio falters, another may well offset the loss for you. For beginners who might wonder where to actually put their money, a number of options offer relatively straightforward entry points. If your employer offers a 401k plan with matching contributions, that should be your absolute first priority. When your employer matches your contribution, well, that's basically free money, an immediate return on your investment before any market gains. Beyond that, robo-advisors have democratized professional portfolio management, using algorithms to build and maintain diversified portfolios for fees that range from 0.25 to 0.5% of your account balance each year. Index funds and ETFs offer another accessible path, letting you buy into hundreds or thousands of companies in a single purchase, achieving instant diversification without needing to research individual stocks. Common mistakes plague new investors, and awareness can help you avoid those pitfalls. Panic selling during market downturns locks in temporary losses that might have recovered. Chasing hot stock tips from friends or financial media without doing your own research generally means you are buying overvalued investments. Failing to review and rebalance your portfolio means your asset allocation could drift over time, exposing you to more risk than desired. And probably most importantly, investing money you'll need in the short term sets you up for possible disaster, since markets can decline significantly over periods of months or even a couple of years, even though they tend to rise over decades. Remember, investing is not about getting rich quick. It's about steadily building wealth over time through consistent contributions, patience, and sound decisions. The earlier you can start, even if it's with a small amount, the more time your money has to compound and grow. Yes, markets will see ups and downs. Sometimes they will show dramatic shifts. However, history tends to reward the patient who stays the course through volatility. Your financial future is waiting to be built, and every day you delay is a day of potential compound growth that you are leaving on the table. If you found this helpful and want to continue learning about building your financial future, be sure to like the video and subscribe to the channel. Your journey to financial independence starts with a single step, and that step might just be today.